Today, we lowered the policy rate by 50 basis points. Looking ahead, GDP growth is forecast to gradually strengthen to around 2% in 2025 and 2.25% in 2026. We also expect growth in residential investment to rise as strong demand for housing lifts sales and spending on renovations. If the economy continues to evolve broadly in line with our forecast, we do anticipate further cuts in our policy rate. And as I said, we're going to continue to take those one at a time based on the best available information. If the economy continues to evolve broadly in line with our forecast, we expect we'll be cutting rates again. Well, Greg, as I indicated, for a number of reasons, we thought it was appropriate to take a bigger step today. That's what we've done. We've continued to indicate we expect there will be further cuts in our policy rate if things evolve broadly as we've expected. Our forecast has growth picking up gradually, 2.1% next year, 2.3% in 2026. It's a pretty good-looking story. Lower inflation, lower interest rates, a pickup in growth. On the upside, though, we know housing is very interest sensitive. As we lower rates, we've got a pickup in housing in our forecast. That could happen faster, could be bigger than we are expecting.
As you know, we've been watching housing closely. It's one of the most interest-sensitive parts of the economy, so it's always a sort of a leading, an area of the economy that responds quicker to changes in interest rates. In our forecast, we do have a pickup in housing. It is possible that the combination of lower interest rates and changes in mortgage rules could mean that pickup happens sooner or faster or stronger than we expect.
Wait, did you catch that in Governor's announcement? Rate cuts, growth pickup, and a boost in real estate activity? Sounds like the government wants the housing market to heat up again. Why? Let me break it down. Think about 2 years ago. Prices were skyrocketing. Inflation was out of control, so the government raised interest rate to cool down the market. And it worked. Consumer spending dropped. Inflation eased, and the housing market corrected. But now they're talking about rate cuts and boosting real estate again. Why? The construction industry is a major driver of the economy. It creates jobs, boosts other sectors, and generates big revenue. So, with the cheaper borrowing cost on the horizon and the new policies for the first-time buyers, like raising insured deals to 1.5 million and longer amortizations, the market primed for more activity. Now, the question comes, is now the time to buy? So with the cheaper borrowing cost on the horizon and the new policies for the first-time buyers, like raising the insured deals to 1.5 million and longer amortizations, the market's primed for more activity. Even the opposition is pushing to remove GST on new homes under 1 million. Sounds like a big shift, right? But here's the thing, whether you buy at the bottom or just before, you'll win when the market trends up. Buyer's market advantage right now is the buyer's market. With bank foreclosures and distressed deals, you'll have the power to negotiate price, terms, everything. But when more buyers jump in, that leverage might disappear. So don't rush, just get active. Know your budget, watch out the market, and be ready to pounce on the right deal. Want to know more or get a tailored market analysis? DM me. Let's find you a great deal before the shift hits.